If you're talking to a founder, what do you tell them?
Oof. The thing that sometimes annoys me about the way we talk about this market is people will look back at these companies and they say, how could people have been so silly? Like, of course, none of these companies were going to work out and they were all just driven by low inflation rates. And then you look at their growth rates during 2020 and you're like, wow, that's fantastic.
Right.
Yeah. Legit.
It was legit. Like,
Yeah.
all the other markers of product market fit, they definitely had them when money was free.
Right.
And now that money isn't free, a whole range of businesses move from must-haves to nice-to-haves. And that's just like the way of the world. It wasn't like people made terrible mistakes. I'm sure there were overfundings, etc. It was that the world shifted. The biggest factor that everyone should keep in mind when it comes to startup fundraising is obviously interest rates. Whatever the Fed does will have major impacts on the level of capital being invested into these new businesses.
Welcome to the Founders Journey podcast. Inspiration, education for founders by founders.
Well, welcome back to the Founders Journey podcast. Back with a repeat guest. We've had, I think, at least once, if not more than once before. Peter Walker is the head of data analytics with Carta. We love to have Peter back every, a couple times a year just to sort of talk about what's happening in the investing world, in the startup landscape. Kind of startup, earlier stage, Series A, Series B, and beyond. And Carta has a viewpoint on that. They're sort of the house where all this data lives, and Peter's the guy who makes sense of it all for us. So Peter, thanks for coming back.
Thank you for having me. Yeah, I like to think of myself as the maitre d' of the house and all this stuff. That works perfectly.
If it's a house, wouldn't you be the butler of the house? If
Sure. I mean, look, I don't want to get too bogged down into that.
All right. Well, we got two Peters on today, so I got to try to keep myself straight here. But so, Peter Walker, what's the state of affairs? I mean, where do we stand today from a startup funding landscape?
So I think in this case, it's important to keep in context the thing that everyone's probably already thinking about in their brains, which is we just went absolutely wild in 2021. We really did. And I think the scale of that bubble has become more clear the further that we get away from it. So put some context on this. Something like $220 billion invested into Carta cap tables in 2021 versus, 70 maybe. So in 2023, and probably on track for 70 or 75 so far in 2024. So it has been a real struggle. There's a lot of differences when you look by stage or by industry. Everyone's familiar with the bubble that seems to be happening in AI, or AI companies are functioning one way and everybody else is fundraising like it's in a much more sluggish fashion. But I think that's the biggest context, is that it feels so different than it did just a couple years ago. And that has ripple effects through how it impacts founders, how they then impact hiring in startups, is like cascading sort of dominoes down the line.
So if you look at it today, I mean, that's like a third, right?
Yeah.
We're at like a third from where we were in 21.
Mm.
Is it normalized, or is it just fell off a cliff?
I'd say it's normalizing now. So especially if you look, it was impacting the latest stages. So the closer you were to IPO, the sharper the turn, really. But it's kind of impacted every stage now. Series A fundraising is down about 50% compared to the first quarter of 2021. That's true for Series A, Series B. Series D and beyond, it's more like 60 or 70%. But those things have leveled off. Like, not very many places are still falling on a relative basis. So things are, if not picking back up, then have plateaued. I guess the first step in recovery is just making it not worse anymore, which it feels like it's happening now. There's like some consolidation happening. But as you look out over the next year or so, the biggest factor that everyone should keep in mind when it comes to startup fundraising is obviously interest rates. So whatever the Fed does will have major impacts on the level of capital being invested into these new businesses. It just, as capital becomes more risky, fewer and fewer people feel like they need to invest in it.
Is there a segment you're seeing that's recovering faster You said they are recovering at different rates, but is there one coming faster?
I mean, AI definitely has functioned in a very different way than the rest of private tech over the last year and a half. AI companies are, there's a joke going around Silicon Valley that they, when you talk to VCs, it's like they haven't even seen a pitch deck that doesn't have AI in it in a year. So it's,
I haven't.
yeah, exactly.
I'm gonna ask, like, is there a qualification of how you become AI? Because it seems like everyone says it.
Yeah.
It's used to kind of for that purpose to get interest,
That's a really interesting question. That I think has been changing lately. So at least in our data, when you take a look at valuations for AI companies, the difference in valuation for an AI infrastructure company, either building dev tools for other AI companies or building foundational models themselves, those have continued to appreciate very robustly. But the valuations for companies that are using AI as part of their tech stack, those have drifted a little bit back towards the median for, say, standard SaaS. So it does seem as though investors are being a little bit more discerning about the kinds of AI they're willing to assign very high outsized valuations to. But there's no doubt that, I would expect moving forward for AI to be less the front page of the pitch deck and more, this is our tech stack. And of course we use this kind of AI because that's the latest technology that we should be taking advantage of.
Yeah. So incorporating the basic components of like Gen AI or something is not going to be the difference in going out. I mean, Peter Dean and I are old enough to remember the .com bubble, right? And doing investing around that time. And, you would see this all the time, right? When the .com bubble started to really expand, every business, it became peterwalker.com, it became peterdean.com, everything, and you started to see that. And I still see that today, not with .com, but now it's, peterwalker.ai is the latest thing, and it's just kind of something that incorporates Gen AI. I think what you're saying is that's not really though where you see the real activity around AI investing. That's not the kind of thing you're seeing now.
It sounds like core infrastructure type AI. Like what is the foundation for the future for building or leveraging the technology for a problem?
100%. Although I will say, if you look across, AI, some people think of it as an industry, but really it's a theme or like a technological shift. So it could obviously impact many different industries where Gen AI has gotten a ton of the focus and the attention since the launch of ChatGPT. I think there is sort of an underreported story of AI in, say, less sexy industries. So either in manufacturing or in biotech or in hardware or in other places where these AI models, and maybe they're not even generative, will start making significant differences to how those industries work. It's just going to happen on a less, robust or like a less acute timescale, I should say. So AI is still the story. When you ask the original question, which sectors are doing better, AI is one of them. The other two that I would mention, climate tech is doing pretty well. Everything is down, but perhaps that's held up a relatively better. And then sort of there has been a bit of a shift, not a gigantic shift, but a noticeable one between like core tech businesses and people that are building real world industries that are hardware, biotech in particular. Those real world industries seem to be getting a little bit more attention from VCs than they used to. Maybe, with multiples coming down from SaaS companies, people are looking a little bit more broadly for returns. But those are kind of the 2 or 3 big takeaways on the industry side from us.
When you look at kind of your traditional B2B SaaS or even B2C SaaS, what's, kind of bread and butter sort of SaaS that carried the market for a decade or more? What's happening there?
Tons of things are happening. Let's put it that way. One of the difficulties is how are they going to incorporate these new technologies, AI being the first one. But the second difficulty that I think is people are not talking about quite enough is that category of thing, like the standard B2B SaaS company, got really crowded in 2020 and 2021. So part of the reason why it feels so sluggish on a fundraising side is because so many companies got funded in the boom times. And now they're looking around and they're saying, I don't really know where I sit. This is kind of, we have revenue. This is a real business, but it probably isn't going to be the venture scale outcome that we thought it was going to be. So do we take bridges, extensions? Do we shut the company down? Do we do a down round? These are all ideas and things that are floating in the ecosystem. And it seems like everyone you talk to is facing similar challenges because there was a glut of companies that were funded at the seed stage in particular over the last 3 years.
Yeah. It's the company, and I think Peter Dean, you see this all the time too, right?
Yeah.
It's the company that got to 3, 4, 5 million in ARR.
Yeah.
That's kind of sitting there saying like, okay, right?
Yeah,
our growth is slowed to now we're growing at 20% or less, right?
We're not a PE company. Yeah.
Right. Now, what do you do? And I mean, if you're talking to a founder, what do you tell them? Right. Like, I mean, what do they do to kind of navigate? Because like you said, it is a real business, right? You're not going to ditch the thing and say, okay, we're out. Like that doesn't make any sense. So where do you point them?
Oof. It's, obviously it's an individual discussion, founder by founder, company by company. I think a couple of the strategies that we hear discussed though are sort of twofold. The first one is, do you need to recap this business so that everyone understands where they sit on the cap table? And maybe we got a little too aggressive with the valuation 2 years ago, and this business would function well. And we think it actually could be a great outcome if everyone owned a different portion, right? If the valuation was much lower and we did the down round and we like took the pain now. That is true for some companies. The second is that has been a lot of companies that have become, and investors who've become looking more favorable on the idea of strategic acquisition. So getting these companies acquired or M&A. The problem with that is that M&A, while it hasn't shut down, there are still deals being done. It hasn't really grown that much either on an absolute numbers basis on Carta. It's like about 140 companies that are on the Carta platform get acquired every quarter. That's been flat for the last couple of years. So that's, again, this sort of gets into the glut idea. Mm-hmm. There are a lot more companies, a lot more founders from what we hear that are willing to sell, but not a lot of buyers that are willing to buy, at least at the prices that they currently would have to buy at. So again, there's a mismatch between a lot of these companies. And the thing that sometimes annoys me about the way we talk about this market is people will look back at these companies and they say, how could people have been so silly? Like, of course, none of these companies were going to work out and they were all just driven by low inflation rates. And then you look at their growth rates during 2020 and you're like, wow, that's fantastic. Right. So it's not legit. That it was legit. Like, yes, all the other markers of product market fit, they definitely had them when money was free. Right. And now that money isn't free, a whole range of businesses move from must-haves to nice-to-haves. And that's just like the way of the world. It wasn't like people made terrible mistakes. I'm sure there were overfundings, et cetera. It was that the world shifted. And that's like sometimes, people castigate founders who grew up in that period. And it's like, I guarantee if you had grown up in the period of free money, you'd be doing the same.
100%.
Yeah, that's a fundamental thing. I think we need to internalize and get comfortable with, because these companies were feeding an economy that needed them. But now, like if you're selling lemonade on the road that doesn't go to the new stadium, you're not going to have anyone on your street. Right. And you're not going to really have anyone to sell to. So that's fundamentally what's happened.
Peter Dean's learned that lesson all too well too. We've been trying to get him to stop the lemonade stand thing, but he still continues to believe there's a real market there. So
Peter's like, call me next time. I'm happy to be an angel investor.
I have a good street for a lemonade stand. We just had the Belmont literally around the corner for me.
It can't be worse than the other places that I've put my money. So it's like
super creepy when you see a guy in his 50s with a lemonade stand.
I mean, honestly, the fact that everyone negs it is probably why it's
They're gonna be like, who is this guy?
That's right. It was a good business at 21, man. It just it's interesting though, right? When you look at these companies, and I'm on board meetings 4 days a week, right? And I think the two things you hear, and ours are primarily SaaS, B2B SaaS.
Yep.
The two things you're hearing over and over are vendor consolidation and elongated sales cycles. Over and over and over again.
You think that that's actually on the vendor consolidation point? are you running up against or or like markets have gotten very crowded with new entrants, so consolidation is harder? Or is it really just we're actually going back to the big players that we've always known, and we'll just do 8 things with HubSpot, even though HubSpot only does 3 of them super well?
Peter, Dean, I'd love to hear your answer on this too. I think it's my answer to that would be it's both, right? That you had when money is flowing, it becomes easier for a niche player that's solving one problem to come in, free up capital, free up budget, and be able to go solve that problem.
Yeah.
But it is the classic definition of the nice to have, right? It's really nice if we can solve this unique problem with this specialty tool.
Yeah.
But when it does, when you can't, you end up going back to the broader platform player who says, yeah, I've got the functionality to do it. It's not that great,
Sure.
but it's going to solve the problem for you, right? So I think you do end up seeing this reversion back to the big platforms, right? If it's, I see this in various businesses, the Salesforce.com keeps expanding the reach. Workday keeps expanding the reach. Like the Oracle keeps expanding the reach. And they're starting to have 50% solutions, but knocking out more specialty players. I think that's where I see it. I don't know, Peter, Dean, I don't know if you kind of see it.
I mean, our customers tend to be the smaller ones, right? So the ones that are filling the gaps, the ones that are winning are the ones that fundamentally are having a big impact on that business. And then you can close a deal, right? This is kind of what Peter was saying before, that the nice to have stuff is like you're dead in the water, right? And if they have a partial solution on the big thing where it's already built and you don't have to do an integration, we're probably losing the day there, right? It's really hard to close. And the sales cycles are all longer. Like they are legit all longer. We have fintech companies we work with. We have sales enablement technology. We have HR tech we're working with. All those things, the sales cycle is much longer. The ARRs are lower. They're getting squeezed down because we have to fit in a profitable model for the customer, depending on who you sell to. Even on the big, fundamental business, if you're selling to big businesses, we see that too. Definitely a crunch and everything because everyone's just cautious. Yeah. There's a lot of cautious buying going on right now.
Yeah.
And it's tough on the sales and marketing team, and that's where I live. So
how does this translate down, right? So, and you alluded to this earlier, when funding gets harder, budgets tighten both with customers and then the company themselves. How does this translate into the life of an employee in a earlier stage company?
It's made significant impacts. So as you can imagine, if you view this as the funnel, where this top of the funnel is the just net fundraising dollars and fundraising activity, as startups start recognizing, hey, it's going to take longer for me to get from C to A or from A to B. I'm going to need to make this cash last a lot longer than I was anticipating. What do? They look at their total spend and they say, okay, what are the biggest categories of my spend? Software and payroll, almost always, or and payroll sometimes. So on the payroll side, one of the things that is easiest to do is your first step isn't necessarily a layoff, but we can talk about layoffs. It's often just a hiring freeze or like a much reduced hiring over time. So we saw that happen, in 2022, companies on Carta added like nearly 500,000 new employees. In 2023, that was 260,000. So cut in half.
Yep.
And if you actually just take the net growth, so total new hires minus total people who departed either through layoff or by choice, startups on Carta actually shrank as a net headcount in 2023. The first time that's ever happened on our platform. So every single new hire is being scrutinized, and people are actually, it kind of feeds on itself, because as that happens and those companies stay, growing revenue, et cetera, then investors are saying, oh, look, the median Series A company, it used to be we would see companies with, 20, 25 employees, and now we're seeing them with 15. So that's the new normal. And then you just continue to not hire very much. So it definitely has rippling effects to employees down the line.
What are you seeing happen from a stock option standpoint? as well. Are you seeing that impact? I mean, we're talking about assuming this, if somebody's laying off or there's salary reductions, but so much of the startup world operates on options. What
Yeah.
what do you see happening there?
Yeah, the equity side has been fascinating. So that's sort of the tail end of the funnel where the first step is actual labor dynamics, hiring and firing and layoffs. And then the second step is, okay, how does that labor dynamic impact equity and compensation generally? So, there are a ton of great candidates on the market right now through a ton of layoffs, both from big tech and small tech. So there is a shift of leverage on the compensation side to the employer.
Mhm.
So, if you're coming in and in 2021, you're an engineer and you had 4 offers and you could make that equity package skyrocket because you're playing them against each other, that's not the case anymore. And you can see it reflected in the equity compensation that's given to employees. So equity comp, the average equity package over the last, call it 18 months, is down about 36% on Carta. That's not because the companies are worth less, even though that's true. The valuations have declined. It's because literally you're getting 36% fewer shares on an average
Really?
basis. Yes. So that's a big shift.
Yeah.
And equity always moves more quickly than salary does,
Right.
probably just because it's much more opaque,
Right.
As you're an employee, you're walking in, you're like, okay, I kind of have an idea of the salary number I want, but on the equity side, I don't know, like surprise me.
Right.
And
I don't know what 100,000 shares actually means. So,
Yeah.
right.
What is
Right.
the
It could be out
context
of-
of that
It could be
today?
out of
Yeah.
100 million. It could be out of 2 billion shares. Who knows? But
Right.
which is, we have a ton of resources to help people negotiate because I think that's one of the big education points that's missing from the world. But the other part about comp is it's, equity grants are only one side of it. Then you've also got the exercise rate. So that's the employee view of how valuable this equity is when I actually need to make a choice to keep it or not. In the money grants. So this is not just underwater grants, which are obviously not usually exercised for obvious reasons. In the money grants are being exercised at the lowest rate they've been exercised in the last 6 years. So it's only about a third of in the money grants are being exercised. So when do you exercise an equity grant? You can do it from any time after it vests, but to be honest, most employees do it when they leave.
Right.
Let the equity build up, and then they leave the company either through layoff or by choice. And then they have that 90-day window, and they have to make a choice about whether or not they pay out cash upfront to actually own the stock in anticipation of it growing in the future.
Mm-hmm.
Something like 2/3 of employees are saying, no, thanks, I'm not paying for that equity, even though I earned it.
What does that tell you, right? I mean, it seems like there could be two reasons. One, people don't have the money to exercise, or
Yes.
two, those employees know something about the health of that company that maybe the world doesn't, right? I mean, that's sort of the classic insight.
Or is it that they didn't really think it was a real thing anyway? Like, or they don't
Right.
think it,
Didn't understand it to be.
they're not like trading it on like thinking, hey, I own a piece of a company, right?
Right.
Yeah, if we're taking that like reason pie there, I'd say like 30% of it is lack of education, not understanding in the first place, for sure.
Yeah.
30% of it is, even if I think this company might do well, I don't have enough conviction to give up valuable cash now, and cash is more valuable now than it used to be.
So right.
The third one is the other part that you just mentioned, though, which is I know something about this company that the broader world doesn't.
Right.
And the reason why we think that is the primary reason is just because as funding rounds get stale, as you haven't fundraised for a while, like, yes, your 409A FMV value should change if you're doing it every year. But on the broad sense, you don't know that business, you don't really have a ton of insight into how that business is doing. Well, you do if the employees are not exercising at really high rates. That suggests that the employees think this equity isn't going to be worth it long term. And I think that's definitely been the case for a lot of people. And especially, the other thing is, we didn't talk very much about emotion here, but if you get laid off, that's an emotional experience. Like,
right.
Through these people, like, I'm going to give them more money right now to, like, you just laid me off. I don't want this share.
Right.
Yeah.
Right.
Yeah. Interesting. Cause I have a question about that and the education piece you had. I mean, fortunately and unfortunately, Greg and I have been through cycles. Like, there's cycles that go. I was at a pitch event for a company that just got funded, and one of the other old guys there with me was like, oh, he's in manufacturing, and this is a manufacturing tech. company. And there's a lot of good economic I mean, it's a good time for manufacturing in the US right now. And he was telling me how good it was. He's like, I know this isn't me. I'm in the right place at the right time right now. And are some of the employees like looking at the company and going, whoa, it doesn't look good. They're laying people off, not knowing that maybe what they're doing is really fundamentally good for that company to have it grow, and we can come out of a cycle, like who knows when, but we're going to be back in a bubble again someday.
I think the general employee population at startups is a super intelligent one.
Yeah.
Most of them understand that, hey, the world that we lived in when I was hired isn't the world that we're in now. Right. And there may be differences that the business needs, different changes that the business needs to take, not just, hey, we overhired, so we have to get rid of the people that we overhired. But hey, because of the way the world has changed, our business is fundamentally different. We might be building a different product in a different way. And so then there's a mismatch of talent in-house versus the thing we need to build. Totally fair. I think a lot of employees recognize that. The difficulty that I have come up against is employees are willing to do that once. Like, hey, you had a layoff because we messed up. Like a lot of people did. Layoffs became the meta. The second layoff or the third layoff, then not just the people who leave, but the people who stay, they're like, why would I believe in this management team? Right? This management team clearly doesn't get it. And that's part of the feeling that I'm getting. Unfortunately, when you look at retention, it's actually probably pretty high because they're looking around at their other friends and they're going, well, I'm not going to leave this job by choice. Like, it's kind of not a great market out there. I'm going to stick around.
Yeah.
So it may be that some of those retention rates are higher than they would be if the market was better.
Maybe inflated. Yeah.
Yeah. Exactly. And I think you see that, right? You see that in down markets all the time where, people will hang on, but it is, it's one of those things. And I've been involved in a lot of these things, unfortunately, where, when you have a portfolio of companies, I mean, you have layoffs across that portfolio, right? And you see multiple rounds of layoffs and things. It's really hard to kind of figure out. You're sort of trying to ride this wave down almost, right? And it's like, I think it's easy when somebody inside of a company says, well, how do they not know this? Because nobody knows this right now, right? And your impetus is always to say, I'm going to do less than I maybe should do.
Sure.
Because I'm going to keep hoping that things turn and you sort of ride that down, right? It is kind of a natural thing, but you're right. It erodes credibility. It erodes trust. It erodes all kinds of things that have long-term consequences, right? For when the market does rebound, you're losing so many people out of the startup world that there's going to come a time when the market rebounds.
So that's a fantastic point that I don't hear being spoken about enough, which is, there's a part of me that thinks that the most people to ever work in startups at the same time would have been in early 2022. Probably. It may be that startups as an industry are permanently smaller now, not just because of the layoffs and the dynamics with interest rates, but also if it's true that you can build a great company with fewer headcount, then that will be the way to build that company in a capital efficient manner moving forward. And that's good, right? That's like, we want companies to be healthy and have healthy balance sheets and capital efficient growth. On the other side, I got into this business by joining a super early startup, and it was an amazing experience for me. And I hope people still have the opportunity to do that.
That's a really good point, because going back to the .com era, everyone was fighting to get in at one point there when it was like really strong, different culture. You just have to be smart in the room. That's all they cared about at a time when, that wasn't necessarily the case everywhere else. It was so hard to break in. And then that bubble came, and then everyone came in. And then a lot of people left. And so it feels like we've done that again. But it will build back up. But it is, certain people are good fits in that world. And
like I want the opportunity for startups to be open to everyone. Obviously, this is not a blanket statement that says like startups need to hire more. That's dumb. But what I don't want to lose is the ability for people to say, hey, instead of, I'm speaking my own book here, but instead of like going in consulting or doing whatever, like I'm going to start something or I'm going to join a super early team. I think that the difficulty is like a lot of people can see the value now of being a founder, right? They're like, I get it. Founders are very lionized, at least here in Silicon Valley, et cetera. What is lost is like, what is the amazing value of being a first 10 employee or first 20 employee? And candidly, it's a more difficult case to make because your equity is a lot lower, but the risk that you're taking on is effectively equal in many cases.
Right. The other thing too, Peter, that I think is, and you started to hit on this, and I see this not all the time, not only in our own portfolio, but in conversations that I have. There is another thing I think that's happening, that the level of efficiency that a company can gain now by outsourcing or going offshore, out of Silicon Valley, out of the United States, it's really hard for me to believe that boards and investors are going to be real quick to say, hey, let's go hire now 20 new engineers in Silicon Valley, pay $500,000 a year, when I know, because the quality of talent on a global level is coming up, right? So there's this other, I think there is this sort of macro force that's happening that it is interesting to say, like, did we hit the peak of, sort of peak startup talent in 22? And will it ever actually come back to that same level again in the US, right? Because I think what you'll see is it will come back, but it may not come back in the US. It may come back in different forms on a global scale, right?
That's a really interesting point. I think that, our data shows that you are definitely right in that people are far more open to outsourcing what would have been considered core jobs previously, especially on the engineering side. Like, there's amazing engineering talent globally, and then there's a cost arbitrage, obviously, not just with salary, but with equity too, et cetera, et cetera. So that's totally true. There's also a shift in some cases towards fractional work. So especially on early stage execs, do we need a head of people right now? Well, we need the advice, but maybe not the full-time, et cetera, down the line. The question that comes up, though, is because that is in contradistinction to the other trend that is happening right now, which is like the removal of remote work in some cases. So it's not that remote work is going away entirely. That's definitely not the case. What's happening, at least for us at the earliest companies that we're seeing, is that they're choosing one of two paths. Either everyone is together all the time in person, or everyone is remote.
Right.
Like, we kind of shift back and forth between those two things. Whereas, at Carta, we're a pretty big company now, and we're like hybrid, in the office sometimes, not in the office sometimes. And it's candidly like, it's great to see people more often, but it does introduce some strain when you're trying to work with a global team. And so, like, I can imagine that not at scale yet, that's an even harder thing to do.
I would attest to that.
I think a lot of it too depends on, like you said, the size of the company, the complexity of the company, but also, what we're seeing a lot now is shifting. I mean, the shift of entire teams working together remotely or working together physically, but remotely, right? Where they're not, you'll have a product team here, you'll have an engineering team here, you'll have a sales team here. Those teams are remote from each other, but those teams aren't remote, as a unit within that team. They're together, right? And I think that's where you start to see it. I mean, we see it in a lot of our clients, or a lot of our companies now, where engineering is all in Poland or something, right?
Yeah.
Or, sales is all in India. They're together, but on the whole, it's separate.
There's going to be a lot of cool new ways to build companies, right? Like, people are trying a bunch of stuff that they would not have tried before the pandemic.
No, and in a lot of ways, I think it's a really exciting, because a lot of what we talk about is, hey, the funding world is tough right now. But I think the thing that we're not talking about that is a really interesting story too is, but the bootstrap world is becoming so much better and so much easier, right, than it's ever been before.
I think it's the question that I have about startups moving forward is this muddy middle between bootstrapping and venture. Because it used to be that these were very clear, distinct pathways, and they're getting more mixed with the way safes work and all this stuff. And there's actually a cohort of founders that we're talking to now whose active plan, not the thing that they were forced into by life, but I am going out to raise one round of funding.
That's right.
I want one round.
I've heard
And
that.
then I'm going
to probably
then I'm going to get up. But big question to me is, I can imagine a lot of those companies doing very well as businesses.
Mhm.
I am struggling a little bit to imagine a lot of those companies making it to a venture scale outcome, 100 million ARR, $1 billion valuation in 5 to 7 years. I struggle to see how you can do that on $5 million in the vast majority of cases. So to me, it's like, are we trying to put venture like type round stuff into places where they probably shouldn't exist at all? And it's just like, it's a cool, interesting thing. I may be proven completely wrong about that.
I think it goes back to what you said before, where there are these fundamental companies that had good growth that are like $5 or $6 million companies, and it's a good business, but it's not doing what that investment vehicle's intention was.
Yes.
And so what do you do? Like, it's a good business. It's not like, what do you do with it? Yeah. And maybe they should have done what.
It's not the traditional VC though.
Right.
That, is going to do that deal. Those deals, Peter,
Right.
we do see those. I invest in some of those, right? Where the expectation is not necessarily though that we're going to get the venture type 100x or 20x or
100 million or bust.
Right. Yeah, exactly. But maybe, we'll buy 10% of the company, we'll be part of a small syndicate of angels essentially. And this thing can, and we have high conviction that the thing can trade for 30 million. And that's a good outcome. It's not a venture scale outcome.
Right.
Yes. But it is a solid seed type outcome for either a small fund or an angel investor.
And as long as there's alignment between the GPs and the LPs on that strategy, I think it makes total sense, right? The difficulty is when you've promised your LPs A on the venture scale and you deliver B on the not venture scale.
Right.
That's right.
Then that's part of the reason why we haven't talked a lot about the other side of VC fundraising, which is not companies fundraising, but funds fundraising.
Yeah.
How difficult it's been for emerging managers.
Yeah, I don't want to talk about that. We're just going to skip that together. So
totally fine.
We don't need to discuss.
Hypothetically, if we were to discuss it, it would look
therapy now.
It would look something like, I feel you. But it's a really interesting point within the venture class, because venture, which this has been true for a while, but I think it's become crystallized this year. Venture is not a monolithic thing. Investing in A16Z is fundamentally not the same as giving money to emerging managers. They are playing different games. And so then the question is, can emerging managers play a 2 to 3x return game at a venture timeline, or do they need to play 5 to 10x? Do they need to keep being super risk pro, like risk on? Whereas something like, the biggest funds in the market, people know like those returns are not going to be 10x returns on a $7 billion fund. It doesn't exist. Right? Yeah. Unless SoftBank is right about every single company they've invested in. Like, it just doesn't happen. Their LPs are cool with that.
Look, this is the world that I live in on a day-to-day basis. And, right before we got on this call, I had our twice annual, I always forget if that's biannual or semi-annual, but whatever that is, LP call. And, and this is one of the topics we talked about, right? Is this concept that we've, and this is not a commercial for my fund, but I mean, I think it's an example of an emerging fund manager and managers here, right? Where, we talk about it as sort of micro level private equity, as opposed to venture, right? We're not taking venture level risk. We are investing in an early stage, but we don't need 1 out of 100 to go to 100x, right? We need solid, we need a solid 30, 40, 50% to do 3, 4, 5x. And we're going to, we show some, we can show some good returns. And I think, that model of the emerging fund, I think, will be something that's more common because you can start to spend a little bit more time with these companies, and you don't have to get those outsized returns. So we can actually partner. And again, it's not just us. There's a lot of early funds that are doing this.
Yep.
We can actually partner. One of our founders on today, we're talking about this, right? We can actually partner with somebody and say, hey, if your EV when you trade is under X, yeah, you're going to give us a liquidation preference that's higher. But if you go over it, that liquidation preference is going to start to fall. And you can start to do things like that to really partner with a founder and not have to we don't have to sit there, we'll make good money on a $30 million exit. We don't have to.
So Greg, what's the liquidity strategy there? Acquisitions?
Strategic.
Okay.
Yeah.
So it does depend in some way, shape, or form on the M&A market picking up then over the next 5 years.
It does. Now, and these are typically like smaller, these are earlier stage, smaller companies under 5 million ARR kind of thing. That M&A market is more kind of tuck in sort of play, but it does. We're also like any other fund. I mean, we're pretty patient with this stuff. We can wait 3, 4, 5 years for that stuff to happen, but so it doesn't have to happen overnight, but it does. It does depend on the M&A market picking up a little bit, but we don't need huge deals to start. We need small, interesting tuck-ins to be able to start. And that they tend to be a little less dependent on the interest rate environment, which obviously, I was joking when you said about the fundraising market for, from a fund standpoint. I mean, it's just getting crushed by the interest rate market today.
Yeah. I love the sort of diversity of models that seem to be springing up around venture and venture adjacent ways of building startups. I think it's fundamentally a really good thing for the ecosystem that there isn't just hit an absolute home run or you suck. There should be a lot of different ways to do that. The challenge that and you probably hear this when you talk to founders too, is like, it's this weird mix of their own ambition and ideas and vision and like the data that they have now about where this business could go. And sometimes those things align and many times they don't align. And then they can point to, one of the things that I think VCs are fantastic at, to their good and their ill, is selling the venture capital journey where, all of the stuff around venture is like, look at Brian Chesky. He was turned down 1 billion times and he was building 2 or 3 other businesses around cereal just to like get some money so that he could make Airbnb. And then it worked. Yep. And then it's like at some point, not Brian, but the other person that was kind of like Brian should have been like, well, if I get to 30 million, that's great. And it's like aligning ambition to the structure of the market is sometimes very, very difficult.
Yeah. Yep. Absolutely. Well, Peter, this is great. It's always having you. It's always fun having you on here, and just a huge amount of insight I think for both founders who are potentially looking to raise, who are raising today or thinking about it in the future, but also, I think just to help founders make better decisions around should I raise, right, or should I bootstrap this thing, and that knee-jerk reaction of, hey, we have to go, the venture route. It's just there's a lot of ways to do this now.
Yeah, and then listen to the advice about the employee side of it. Like, what are they feeling? Be smart about your layoffs, if you have to do that.
Yep.
I don't think you're going to regret over communicating with your employees. There's one lasting message from this podcast, but always fun, guys. Thanks for having me on.
Yeah, thanks, Peter. We'll do it again, and I'd love to have you back on another 6 months. And take care, and good to see you. We'll see you on the next edition of the Founders Journey podcast.